Breaking news, U.S. corporate debt hit a record $12.3 trillion in June 2026, and analysts say a wave of defaults could wipe out ordinary savings overnight. The story starts with a simple fact: corporate borrowing has surged 40% since 2022, fueled by cheap money after the Fed's rate cuts. Companies rushed to lock in low-cost loans, piling debt onto balance sheets that were already thin. But here's where it gets crazy. In the last 3 months, 57 major firms have missed interest payments, a number not seen since the 2008 crisis. Credit rating agency Moody's flagged a systemic risk for the first time in a decade. And that's not even the biggest part. The Treasury's latest report shows that 28% of that $12.3 trillion is held by retail investors through bond funds and 401k plans. When those firms default, the losses flow straight to everyday portfolios. The domino effect started in early May, when a mid-size manufacturer filed for Chapter 11, triggering cross-default clauses in its supply chain loans. Within weeks, 3 more suppliers defaulted, forcing banks to tighten credit lines for hundreds of small businesses. Meanwhile, the Federal Reserve, fearing a credit freeze, raised the policy rate by 0.75% in late June. Higher rates mean bigger interest bills for debt-laden companies, and suddenly the cost of servicing that $12.3 trillion jumped by $150 billion each month. Investors are already feeling the pinch. The S&P 500's corporate bond index fell 9% in the past 2 weeks, and the average yield on BBB-rated bonds spiked to 6.8%, the highest since 2011. That surge erodes the value of bond-heavy retirement accounts. So what can you do before the crunch hits your savings? Diversify away from high-yield corporate bonds, add Treasury inflation-protected securities, and keep an eye on credit default swap spreads for early warning signs. If you want to see what happens next, subscribe now and hit the bell. We'll break down every move the markets make in real time.